Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go. It's generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, let's take a look, and I'll interject my financial opinions as we go. If you want to follow me, it's at finding_finance, and if you want to join our community, finding-value.com, where I dive deeper into these topics and subjects and more freely share my opinions about individual companies and how I'm playing this commodity bull market. So Calvin says, watching everybody crowd into now just three stocks is like watching rats piling on top of each other as a room fills with water. They're gonna drown. I can't wait till the day Apple and Nvidia are limit down and there's no end in sight. I don't know if I'm that negative, but I do think that they are overvalued, and I think a lot of people are piling into those stocks and are chasing returns. It's FOMO. That's the way that I view it and I see it, and it looks like there's other people with similar viewpoints out there. Coastal Journal says the yield curve says the U.S. Treasury 2-year and 10-year yield curve has hit its most inverted level since mid-March, signaling potential economic uncertainty. Historically, an inverted yield curve has been a recession predictor. Well, it's not a recession predictor. What it does is it tells you where you're at in the cycle. So you cycle up and down, you cycle down, up, down, up, down, up, and you're cycling back and forth is what it is doing. And since the yield curve is inverted, what that means is it doesn't predict a recession. It doesn't predict anything. It just means that we're going through the part of the cycle where inflation is high. They increase interest rates, and the yield curve inverts when the short end of the curve goes up and over and higher than the longer end of the curve. So it's usually the 2-year and the 10-year that a lot of people measure. So it doesn't predict anything. It's just telling us where we're at in the cycle. It doesn't tell us how long or a time frame. It doesn't really do that. It just tells us that we're at this portion of the cycle. And during an expansion phase where a lot of inflation is being generated, what basically comes after that is a recession, a slowdown. So where we're at in the yield curve and how it's inverted and where we're at in the cycle all aligns with a late stage expansion phase. And that's where we are currently at. We don't know how long it will last. And most of the time, if you were to look at a lot of the data, you'll see inventory, existing home inventory, creep above 8 months. You'll go into an overbuilt expansion phase. So they build too many new homes and then they can't sell them. Sometimes foreclosures go up. That's kind of where you see a lot of stress in the system, if there's stress in the system. The thing is, we don't have any of those indicators yet. We don't have 8 months of inventory in the United States. There are pockets that are overbuilt, like Austin, Texas is overbuilt, and there are some other pockets, but there's a lot of the nation that is also dramatically underbuilt. And that's where it becomes difficult to try to make predictions on when this will uninvert. A lot of these other ones, the housing market, construction jobs, and employment and spending, that all collapsed before the recession. None of those indicators have collapsed yet. So Gergen says, other than Athabasca, nobody is doing significant buybacks, but I think that those buybacks will be significant soon. And this is Eric Nettles. It's a great day when you get to share the screen with one and only Croft Helma. We cannot intelligently explain the year-to-date or mean-to-date sell-off in energy stocks given the 80 WTI price. They've got massive free cash flows and ongoing significant share buybacks. and are actively adding to key names is what he is doing. And I would agree with him. I don't think oil looks all that bad. And if we do get higher oil prices out in the future, which I think is a high possibility, I think the balance sheets are going to look even better than what they do at 80. They're going to look ridiculous. If we get $100 oil, that is sustained up there. Bullish trend says worst month for Canadian energy is June. You can see June normally returns minus 1.9, and that's exactly what we're seeing. It looks like another bad month is March, as far as I can tell. Those are the two bad months, and September looks like a bad month too. We've got Apple versus URA ratio. It says the wedge broke out a year ago to the downside. Now it's testing from below. Are we going to get an outperformance of uranium here and an underperformance of Apple and maybe some of these technology companies? My answer is I think we are. I think we are. What does it look like? When is it going to be? I don't know the when. I just know that a lot of these charts are lining up for a potential outperformance for a lot of different commodity sectors. That is what I do know. Michael Green says 2001 and 07, 08, they didn't really look like this. Other than looking exactly like 2001 and 2007, they look nothing like 2001 and 2007. So we had a cross in 2000, 2001. We had another cross here in 2007, 2008. And that was signaling the employment to population ratio where unemployment went up and we got slowdowns in the market. We've got this gap here, which they're not crossing, at least not yet. And I think people are confused at what exactly we're looking at because it's not the same like 2007 or 8 or even 2000, 2001. They haven't crossed. We haven't had that same type of signal. So I think people are trying to make ends of where we're at in this cycle. Josh Young says, all I want for Father's Day is declining global oil inventories and historically low oil futures market positioning, which we have. This is the global oil inventories declining in 2024. It's in the red there. And then we can see that global positioning is really, really low in 23, 24. Not many people are in it. Sahara has gold divided by the consumer price index ratio. It's at a break point. So gold could be breaking out against the CPI here at any second and get a big breakout. That also correlates with gold mining companies, gold, silver mining companies' outperformance. We can see when that went up dramatically in the 70s, that's when they really took off, is when gold outperformed the consumer price index. It's basically charting a certain market condition. Last bull market, we had a little bit of it from 2000 upward. But that's when gold and silver mining companies really outperform. Breakwave says, we need a bigger stimulus, Scotty. So China, new home prices, and I hate to say it, but stimulus isn't going to help you for new home prices. But the demographic is what drives this, and they generally are around 30 to 35 years old for new first-time home buyers. And that's really the big driver. It's the demographic. Their demographic fell off a cliff after 2021, and that's really what we're looking at. We're looking at the aftermath of the demographic of 30-something year olds dropping off a cliff. There's just not enough people coming up in home buying ages to create credit and absorb the housing market out there. Giovanni says, crude inventories were at 146 million barrels in April versus about 140 million barrels in March, according to Jodai data. So a big move lower in Saudi Arabia's crude oil inventory, back to pretty low levels, all the way back to 2002 and 2004. And if you look at the demand today versus back then, days of coverage is obviously much, much lower today. Here are 5 ideas from Bill Miller. It says, the asymmetry of past information and future value. As I tell our analysts, 100% of the information you have about any business reflects the past, and 100% of the value of that business depends on the future. And you guys have heard me in some of the webcasts talk about the future and what I'm investing for and what I think the future has in store for some of these companies. Number 2, value traps and how to avoid them. It says the problem is that in most value traps, the fundamental economics of the business have deteriorated, and the market is gradually marking down the valuation of those to reflect the fundamental economic deterioration. Number 3, active management is required for outperformance. To have a prayer of outperforming, an investor must have some active management. Says the result is an opportunity for time arbitrage, which means that by lengthening the time horizon for thinking about a company's results 3 to 5 years out rather than 1 year out, you can increase the probability that you will outperform. And that's exactly what I do. Is I look 3, 4, 5, 10 years out and say, well, is the commodity price going to go up in this time frame? If the answer is undoubtedly yes, and you've got infrastructure in place to produce whatever that commodity is, you have a pretty good chance of making a lot more money in that company, given the bullishness on the commodity itself. It says assessing and talking to management teams. It says rarely will management teams tell you how bad things are, but you understand that going in. So you're really trying to understand how they think about the business and how their views may have changed in recent years. So it says, I think if you found or if you've owned a company for 3, 5, 10 years and had a lot of extensive contact with the management, you can learn a lot from the nuances in the way in which management answers questions, the way they think about strategy, and so forth. Rarely will managements tell you things, how bad things are. 5, 2 pieces of advice on investing. Number 1 is knowing the 60-40 end of a proposition. And number 2, money management. And number 3, knowing yourself. And here's a couple of the bolded sections. He says, I told the guy that if he reads Security Analysis by Ben Graham and David Dodd and The Intelligent Investor, and then read all of Warren Buffett's annual reports, and if he really understands what they are saying, he will know everything there is to know about investing. Number 1, knowing the 60-40 end of a proposition. Number 2, money management. And number 3, knowing yourself. It says, love the perspective. All right, so we're going to go back out. Buying funds based purely on their past performance is one of the stupidest things an investor can do. Quote Jack Bogle. And that is the total returns for the last 3 years. NASDAQ 100 QQQ up 40%. And ARC Innovation rolling on the bottom there. What I try to do is I try to find inflection points where the commodity or whatever they sell is inflecting higher, and there's good value in the company already. That's kind of the best combination of things. So you have to look at things maybe a little bit different than just price performance. You're looking at ratios, technical analysis, and market conditions and cycles of when these things inflect. So Art Berman says global oil demand can only peak in 2030 if Saudi Arabia embarks in a massive oil saving program. If it doesn't, the global numbers don't add up. Saudi Arabia burns about 1.4 million barrels per day of unrefined crude and fuel oil in its electricity plants. So what they're saying is they need to save that fuel and burn it somewhere else, like in cars or whatever. But right now, a lot of this, the numbers don't add up. And I think a lot of people are worried that supply won't be sufficient enough for the demand in the world. And Saudi Arabia is one of those that people are looking at. Caution, U.S. population growth is scary looking chart, nearing 0% levels, indicating almost no growth. This is worse than even the Great Depression. You can see a slow downward movement in year-over-year change in U.S. population, and we are now approaching almost zero growth. We peaked lower in the early 20s, late 10s. We're back down to those levels again. A lot of economic growth is dependent on demographics and a growing population. We can see here that if you add 30 years, first-time homebuyers in America is actually 36. So this big population pump right there, if you add 36 to it, so call it 1990 at the beginning, and maybe it ends in 93 or 94, that's the demographic that's coming through home buying years that is causing family formations and a potential shortage in the real estate market. It's this little pump there, the bump right there, boom. So you add 36, that puts you at 2027 is probably a likely area where we could slow down a little bit, maybe even all the way out to 2030. It says the United States needs at least 1.5 million additional homes and likely many more to relieve the nation's housing shortage, according to Freddie Mac. So we still have that big deficit, guys. We still have a lot more homes to build in order to satisfy the needs of housing. Now, I've read a whole bunch of different estimates of where that is. They say 1.5 million. I've read it as high as 7 million homes. Who's right? Tough to say. It says for anyone who sees the oil market in surplus, check out these graphs. So this is U.S. crude imports are at the highest, so we're importing more crude. What's going on there versus history? And then the Biden administration is ready to release more oil from its strategic stockpile to halt any jump in petrol prices this summer, as the White House battles to contain inflation ahead of the November election. But yeah, we've got all this oil market surplus, right? But we've got we're importing more oil, and he's ready to release SPR barrels. Kind of interesting. Never forget this time it's different. Forward PE multiples, the S&P 500 SPX at 21x. Yeah, that's bubble territory, boys. It's bubble territory. And the only time it's been higher is 2020 and also the 2000 bubble. China new home sales fall further, and while some may say that the real estate is now not so important for China, it remains a key driver of wealth effects, and that is negative. Meaning, the data dump that we'll get in 10 minutes will likely show a further misaligned economy where consumption falters while supply rises. Shanghai gold premium is back at 1.34%. Gold will go higher, is what this guy is saying, because of that premium where more gold is going to be shifting from the west to the east. Ronnie Stofferle, he says, the wonderful folks at the Daily Shot are taking a look at commodity markets correlations to the S&P 500 and the US dollar. So negative correlations and positive correlations. Surprisingly, we see a positive correlation between nat gas and S&P 500 and the dollar. A slight positive correlation. U.S. gasoline is very correlated with the S&P 500 and a little bit correlated to the U.S. dollar. Some really big negative correlations. Aluminum. Aluminum is highly negative correlated to the dollar, so you want a weaker dollar, and slightly negative correlated to the S&P 500, which is one of few assets that are negatively correlated to both. Soybeans, lumber, silver is even. So this is the correlations. Greater correlation to S&P 500 is up. Negative is below zero. Positive above zero. The Biden administration is ready to release more oil from its strategic stockpile to halt any jump in petrol prices this summer as the White House battles to contain inflation ahead of the November elections. We've got momentum investing is driven by capital flows. Look there for the explanation, and that is a USD story. So momentum investing is still drawing mojo from the Magnificent Seven, says John Authors. The problem is that when big momentum reverses, it will be big time when that does reverse. It says cash combined with courage in a crisis is priceless, and that's what I did in 2020 for some of my entry points. We've got Citibank very favorable on uranium and copper spot prices over the next 12 months. 40% gain over the next 12 months seems fair. That would take spot uranium from around $85 a pound to around 120. So this is their opinion. They're negative in terms of oil pricing and manganese, but they are positive on uranium, copper, aluminum, and zinc. Their opinion there for commodity price upside downside looking out into Q2 of 2025. Art Berman says Doomberg's views on energy are delusional and inconsistent with refinery and economic reality. Thought that was funny there. And you can listen to his economic opinions there on what energy is. U.S. dollar's reserve currency status remains in a downtrend. The U.S. dollar share of the world's central bank's reserves fell slightly to 58.4% in Q4 2023 from 59.2% in Q3 of 2023, according to the IMF. By comparison, the U.S. dollar accounted to 71% of reserves. However, it is worth noting that the U.S. dollar remains the most dominant currency, and it's not even close. For example, bonds share in Q4 2024 was just 2.3%, and the euro's share is 20%. Is the US dollar's reserve currency status safe? It's been declining, but it's been declining quite slowly. And that's what I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website if you'd like, and we'll catch you next time. This is Finding Value.